The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. My name is Megan Cox. I'm the Marketing Events Manager at Kuranos. Thank you for joining us for today's webinar, How Low Can You Grow? Raising deposits shouldn't break the bank or see you. As the industry's leading provider of data, analytics, and technologies, we're here to help you better attract, retain, and grow more profitable customer relationships for your financial institution. If you have questions during the presentation, please type them into the question box in your GoToWebinar control panel. This webinar is being recorded, and we will send the recording and the deck to you via email post-webinar. Okay, Adam and Dan, let's begin.
Thanks, Megan. I'm Adam Stockton, a managing director with Kuranos. I oversee our retail deposit and lending businesses. I'm joined by Dan Otto, who manages our deposit optimizer essentials. For those of you who aren't familiar with Kuranos, we are a company that works solely with financial services companies, banks and credit unions of all sizes to provide data, comparative analytics, and optimization platforms. All of the data that you're going to be seeing today is from our proprietary data sources, built from over 7 trillion in deposit data from institutions ranging from over 1 trillion down to less than 1 billion. And so what we'll be covering today on the next page is really about how to get better with tactical deposit management and reducing interest expense in a really challenging environment. So where do we stand with the Fed cutting rates, uncertain times? I'm sure most of you have been watching the stock market this morning, which puts a greater underline even on uncertain times. How do you cut rates without losing relationships or deposit value? Just about every institution we talk to is really focused on reducing costs, reducing interest expense, but you need to make sure that you're not putting yourself in a position where growth over the next 3 to 5 years is going to be challenging. We are going to dig a little deeper into CDs in particular, which is a muscle that many banks and credit unions haven't had to deal with to the same extent over many of the last 15 years. And then how to think about planning for an environment that's going to continue to be uncertain. So let's jump into it. The brief note on where we are is deposit growth has returned, but we aren't seeing interest expense relief, even though the Fed started to cut. So why is this important? Why is everybody focused on deposits in a way that they weren't before? You can see here, going back all the way to 2012, what does retail deposit growth look like on a year-by-year basis? From 2012 to 2019, a little bit of variation, but only a very little bit. 5 to 7% growth in retail deposits every year. And many banks and credit unions of all sizes, but in particular, many kind of community banks and smaller credit unions basically had the philosophy on deposits: we open the doors to the branches and deposits come in. That's just part of what happens when you're a bank. We don't really have to think about it. We're really, we worked with a number of institutions that said we're really much more focused on how we grow from the lending side and making sure that we can continue that lending growth. We always get the deposits. We've always gotten the deposits. We have great staff in our branches who make sure that we execute on it, but we don't really have to think about it centrally at the bank or credit union because of those staff executing on the ground. Everything changed in 2020, where we got a huge influx of deposits as COVID hit, from a combination of EIP checks, PPP loans, foregone spending, built up huge amounts of deposits that were really slow to run off. And a lot of institutions went from assuming that those excess deposits would run off really quickly to then banking that they were going to stick around forever. And you can see with that 2022 bar, they didn't. Deposits flowed out the door as inflation spiked, as the Fed started hiking rates, and we're still not all the way recovered to those historical levels of growth. So over the last 3 years, just about every institution that we work with has put much more focus and emphasis on deposits. First, growth, which required a lot of rate in 2023. If you wanted to grow, you had to be using rate to get it, because the Fed went up really quickly from near 0 to 5%. And now, as rates have started to come down, the opposite problem. Okay, we used all that rate. Now we need to get some of it back. And how do we do that? The good news on the next page is that customer balances are really back to a more stabilized position. This chart shows average customer balance for all products. So, going all the way back to 2015, the average retail customer had about $16,000 with a bank across checking, savings, CDs, everything they have with a bank or credit union, $16,000. That grew steadily at about the same pace as overall retail deposit growth, right? So, around 5% a year. You see that big spike through COVID. What I mentioned, the EIP checks, foregone spending, and you can see that excess above the blue line. That blue line is basically projecting what if COVID never happened. So what does that trend line look like in those 5 years before COVID? We've now gotten back to it. And that's really when we've seen the stabilization and overall deposit growth. So the good news is, our baseline forecast would say deposit growth isn't likely to be the same challenge that it was there for a couple of years. Of course, there's still potential for uncertainty. We'll put a pin in that for a moment, but there is some good news here, which is the growth side of things is looking positive for the first time in a few years. Other good news on the next page is that as the Fed has started to cut, we've seen most institutions reduce their rate sheet rates. So these lines, the gray in the middle is the average institution. The blue on top is the top quartile, so the ones who are paying the highest rates. What do those rates look like? The pink is the bottom quartile, so those who have paid lower rates through the cycle. What do those rates look like? This is looking at rates for new money that's walking in the door. So new customer, new member, bringing new money to your institution. What are you paying on it? At the end of the rising rate period, the average institution was paying 335 basis points. That's now dropped down to 265 for the average institution. And we can see, each of these categories has dropped pretty significantly. The betas on the right-hand side of the page, for those who aren't familiar, basically take the change in the rate that you're paying, and that's compared to the change in Fed funds. So a 75% beta for those top quartile in the upper left of the table means that for every 100 basis points the Fed went up in the rising rate cycle, those top quartile institutions were passing 75 basis points of that along to the end customer member. From an expense perspective, there's some good news here too. Those falling rate betas are higher than the rising rate betas, which means that so far on those new money rates, banks and credit unions have been able to take more of that to the bottom line than they did on the way up. The not so good news is on the next page, which is looking not at new money rates, but at total portfolio rates. So this is interest expense across all products. And here you can see that average institution again has only decreased by 10 basis points in the falling rate period. So while the Fed has come down 100 basis points, interest expenses only dropped by 10 basis points. That's a real challenge. And you can see here the falling rate betas are a lot lower than the rising rate betas. Meaning for every 100 basis points the Fed went up in the rising rate environment, banks passed on 20. Banks increased their expense by 20 basis points. For that first 100 down, banks have only been able to, and credit unions have been only able to decrease interest expense by 10 basis points. That's putting a lot of pressure on costs. Most of the CFOs that we talk to say, hey, we were expecting falling rate betas to be higher than rising rate betas, meaning we've budgeted for more interest expense reduction on the way down than the increase on the way up. And that is putting bank budgets and credit union budgets under pressure from all sides.
Adam, I was wondering if you could comment a little bit on what we've seen in that top quartile. They've had a little bit better betas on both sides, and kind of what does that strategy generally look like?
Yeah, that's a great question. So, and just a reminder for all of our participants, you can type questions in the Q&A box or the chat box. They both come to us, so please do feel free to ask questions. They will be anonymous, and we'll do our best to get to answering all of them. So those top quartile institutions, but part of the reason they've been a little more successful at bringing expense down, although even then it's pretty modest. So a 17 basis point reduction is there were more aggressive increases kind of across the board on savings and CDs on the way up. So if savings rates were, if kind of top savings rates were over 400 basis points, and we saw on the last page, those new money rates have come down 80 basis points in that top quartile bank. So, a really significant decrease for that new money in the door. And it's a higher proportion of rate-based money. So the average top quartile institution has more money in high rate savings, MMDA, CDs, whereas those bottom quartile institutions have tended to be more successful at keeping growth in checking, which is zero rate. Of course, the flip side of zero rate checking is that there's nowhere for the rate to come down. So you can't get any expense reduction on the checking side.
Okay, thank you.
Putting the numbers in a little bit more context, that average institution still seeing really high deposit costs. Deposit costs are currently 49 basis points higher than when the Fed stopped increasing. So even though they're 10 basis points lower than that peak right before the falling rate environment started, almost 50 basis points higher than when the Fed stopped increasing back in 23, and 110 basis points higher than the last time the Fed was at 450 basis points. That shows, the retail market in particular lags on the way up and also lags on the way down, right? The average consumer isn't thinking about banking all the time. They're more reacting to, kind of stimuli that come along. So I get a tax refund, and suddenly I have a lot more money in my checking account than I did before. I want to earn some rate on that. That's what's driving a customer to look at what rate they're getting, not what's the Fed doing. Even as bankers, if we're attuned to the news and reading the Wall Street Journal every day, the average consumer in America really isn't. And it's important to keep that in mind. A couple other notes on why we continue to see these persistently higher costs. I mentioned a little bit, you know, from your question earlier, Dan, on those deposits at floor rates. So, you know, checking deposits fundamentally have no beta. There's no rate paid on the vast majority of checking. Even interest checking at most institutions is paying 1 basis point or just a handful of basis points. There's also a lot of low rate savings sitting under 25 basis points. So, you know, kind of the convenience oriented savings is very low rate money that just doesn't have room to move down because, you know, banks and credit unions said, hey, if this money is fundamentally looking for convenience, and so it didn't reprice on the way up. It can't reprice on the way down. We're continuing to see remixing. Checking is moving into high yield savings, money market, CD. Low rate savings is moving into money market and CD. You know, for institutions that are running promos, you know, some of that money comes off a promo and moves into a new promo or an exception or into a CD. Again, that kind of goes back to, you know, customers thinking about tax refund, bonus, inheritance, other, you know, kind of windfall sources of money, or just build up over time, and looking for some return on that money. You know, finally, there's just a difference between the new money that comes in the door and what you have on your books, right? Even for the most successful institutions, you know, your members or customers will have service issues. They'll move out of your local area. They'll die, and kind of replacing that money is always more expensive than what you already had on the books. Those factors are really powerful, and we've sized it at the average institution. If you do nothing, if you just hold flat and don't make any changes to any of your rates, the average institution will see deposit costs go up somewhere on the order of 1 to 2 basis points per month, because of all these factors. And so kind of getting to a place where your deposit costs are actually coming down, you have to work against all of this inertia that, if you do nothing, is leading to a natural state where your costs actually go up, even though the Fed is in a declining rate environment. And so that really underscores the need to have really active deposit management and be thinking about what you're doing from a product perspective and a rate perspective on a week-to-week basis, so that, you know, first you're not going up that 1 to 2 basis points every month, and then second, if your goals are actually to decrease, that's 2 or 3 steps, not just 1, because that first step might only get you back to holding neutral. Before we get into the what do you do about it, we had a couple more pages just showing some of these effects specifically. You know, so across the industry, you know, a lot of the easy down pricing has been done. Lots of deposits are already sitting at floor rates. So, you know, you can see here, all right, the 34% in black is in checking. As we noted, that's not paying any rate. So, you know, there's nothing to decrease on that. Even as we look at savings and money market deposits, you know, 43% industry-wide are sitting below 25 basis points already, and can't be fully repriced. And so if you want to decrease your interest expense, you're looking at less than half of the average institution's book has to make all of that cost savings come true. Now, interestingly, that's the story is a little more nuanced for community banks and credit unions. And Dan, maybe you can share some of what we're seeing in kind of the average community banking and credit union book.
Yeah, so to Adam's point there, one thing we do at Kiranos is we create what we call a representative demo data set here for what we think of as community financial institutions, which is anybody under 10 billion of total deposits. And so we do an aggregated trend analysis, bring a lot of things together and create kind of an average view. And that's kind of what I'm going to be highlighting throughout this presentation. And I would also emphasize that everything I am sharing in this presentation is also directly taken from our Essentials application. So these are views that are accessible. You know, if you guys are interested in the Essentials application, that's certainly something we can talk about further. But what we're seeing here is actually within our representative demo data for community banks and credit unions, we're actually seeing a much broader dispersion of rates on the left for the whole portfolio. Whereas across the industry, we're seeing a lot more concentration in lower rates and higher rates, really looking at those, keeping the portfolio rates lower and the acquisition rates higher. Our community institutions are definitely more broad across the spectrum. Drilling in on the right into the MMA and savings category, whereas Adam showed on the previous slide, it was about 45%. We're between that 0 and 25 basis points. We're actually seeing, you know, the closer to 35% in that range. And then 22% higher in that kind of acquisition range, with a large portion of the book actually sitting right in the middle at that 250 to 300 basis points range. That means there is a potential within the community space, as we're seeing it, to take a look at the book and see how much of that mid-book you can move down and potentially get some relief there. All right, let's keep going.
The watch out here, though, so absolutely, we see some real opportunity in the community institution space to reduce rates. The watch out is some institutions that have reduced rates the most aggressively have lost deposits. And so this is just looking at the flip side, the growth, and what's the dispersion been that we've seen on the growth. So, you know, the average financial institution last year, you know, saw just under 2% consumer deposit growth. Those that grew the fastest saw closer to 7%, so kind of right back in that historical range. But fully a quarter of institutions we track, and we're now tracking over 50 institutions of all sizes, lost 3 points in consumer deposits last year. You know, you can see the same thing on the CD renewal rate side on the right-hand side. Those who brought down CD rates the most quickly saw a 10-point difference in overall retention of renewing CDs to those who brought down rates more slowly. Maybe your institution is in a place where, you know, you can afford to run off 10% of your CD book, you know, or 3 points in total deposits. But if you're not, that means you really have to take more of a scalpel approach as opposed to a sledgehammer approach. You know, there's real risk here in, you know, diminishing the longer term franchise value if you're not careful on this front.
Okay, and another thing we're seeing in particular as rates have gone down, again, looking at that representative demo data, this is a very common thing we're starting to see as we're helping our banks and credit unions look through their books. What we're looking at here is a balance flow chart. It's a water flow chart showing how we move from a starting to an ending balance. We're looking here at specifically a product that we're calling new product within the demo set. And what you can see here is as those balance increases are driven by what we call acquisition and switch. So acquisition is new money coming in, whereas switch is money moving internally in institutions. So as Adam referenced earlier, that money moving from our checking accounts into our CDs, right, is a particular flow we're seeing there. So as rates are coming down, one thing we're seeing a lot of is that's driving customers internally to find those repricing opportunities. And that's definitely something that we should be watching out for. And another great way that we can expose that through the Essentials platform and help make that obvious and keep you guys up to date as we go through that.
Yeah, that keeping track of those flows is absolutely critical because, you know, if you've priced looking for new money and all you're doing is repricing existing deposits, those were deposits you already had that you're just paying more rate to in a falling rate environment, and not getting any benefit for it, right? So kind of think about everything else that in a resource constrained world, which we know all of you are working within, think about everything else you could have spent that money on, aside from, paying it out to people who were already there and who fundamentally, most of them didn't need that extra rate. They were happy with what they were getting to begin with.
Yep.
So let's pivot then from, now that we've kind of set the stage on where we are, what do you actually do about it? How do you get some expense relief without losing the relationships, without losing the deposit value? 5 key things that we'll go through. Number 1 is understanding price elasticity. So that means as you move rates, what's actually going to happen from a customer or member behavior perspective? Are your members or customers going to bring more money? Are they going to take money out and look to one of your competitors? Are they going to do nothing? Kind of making sure you understand that. Second is really having a pulse on the competitive environment. Particularly in these uncertain times, we've seen really significant swings in CD rates when it looked like the Fed was going to cut aggressively, then when they pulled back. Knowing what your local competitors are doing, as well as having an understanding of the broader market, the landscape of digital banks that many of your customers and members are also looking to. And making sure that you're staying on top of that as those change, which is often weekly these days. Third is watching attrition, meaning the balances that are walking out the door. And critically, are you not only losing balances, but are you losing customers? There's a bad case, which we talked to a little bit earlier on the deposit growth side, where a quarter of the institutions we track lost 3 points of deposits. That might be okay, depending on what your funding need is. If those customers or members are taking an active and primary checking account with them, that's not a bad case, that's the worst case, because you are limiting your ability to continue to grow into the future, and risk shrinking not only deposits, but customers or members. Understanding longer term impacts of the decisions you're making today. Are there moves that will save a very little bit of money today, but limit your ability to grow in the future? Or are there places where you could reallocate some of those savings? In particular on CDs, we'll walk through a couple findings around, how customers and members think about renewing. And then being able to pivot quickly. The only thing we know about what's going to happen over the next year is that none of us know exactly what's going to happen over the next year. And so, making sure that you have ways to shift if the competitive environment changes, if your goals change, if you suddenly are looking for a higher level of deposit growth or a greater degree of expense savings. Do you have the tools where you can make those trade-offs really quickly? So let's jump into it. The first key here is that price elasticity isn't linear. Now, what does that mean? That's, kind of technical jargon speak, right? Basically, what it means is there are points where if you increase your deposit rates by 5 or 10 basis points, absolutely nothing happens, right? You can think of the x-axis across the bottom here as the rate you're paying, and the y-axis going up as the deposit growth that you're getting. That wide area in the middle is the area of indifference, where maybe you change your rates from 310 basis points to 320 basis points. If that's in the area of indifference, you see absolutely no change in your deposit volumes, but suddenly you're paying 10 basis points more for all of your deposits. That's an incredibly expensive move. You have to find, if you're looking for growth, you need to make sure that you get out of that area of indifference and move to the right where you can actually come up the curve and you're paying enough to actually get growth. There's an equal warning on the left-hand side of the page where if you price down too far and you start to lose those deposits, it gets really expensive to reacquire them because you can't just go back up a little bit. You have to go all the way up to that teal X on the right-hand side of the page. So if you go down too far and lose too much, it gets really expensive to reacquire them. These dynamics, by the way, aren't just true for financial services, right? I always think about the price of gas, right? Are you going to drive across town and turn left across 3 busy lanes of traffic to save 5 cents a gallon? I'm not, although some people are, right? But for $1 a gallon, yeah, you can bet that I would feel like my local gas station is taking advantage of me if they, increased rates at the pump by $1 a gallon, and I drive a little bit out of my way to go to somebody that wasn't taking advantage of me. That's the exact same kind of theory that we're seeing here in deposits. Let me make that a little more real for you on the next page. We hear so many community institutions, banks and credit unions say, our rate strategy is we don't want to be the best and we don't want to be the worst. We just want to be a little bit above average, right? Because rate isn't our value proposition. Our value proposition is the people that we have in the local market, the ties that we have to the community. We think we offer great solutions. We don't just want to attract hot money with that rate, but we recognize that we can't pay bottom of the market either. So we want to be a little bit above average. That is the absolute worst place that you can possibly be. Why? Because it's not high enough to attract new consumers in the door. For the people who don't know you, aren't as well versed in your ties to community, don't have experience with the solutions that you offer, the fantastic service that you offer, or whatever your value proposition is, those rates won't be enough to get them to say, gosh, I'm going to try them out. And that's really what you need. You need to kind of take somebody away from where they are today, or even if they're moving into your local market, you need to stand out in the crowd. And rate is one of the ways to do that. On the other hand, being a bit above average means that you're probably paying more than you need to for the customers and members that you have who are already totally bought into the value proposition, who say, yeah, I love all those things that you offer. As long as you're fair on rate, I care much more about that other stuff. That's probably too much rate for those folks, and that means that's money that you don't have to invest in making all of those other things better. To do more sponsorships in your local community, to offer kind of more perks and rewards, to offer better service. So that just above average is the worst place to be. So
yeah, to reference back a couple slides ago, that balance water flow, this is the area when you're just above average that you're maximizing that switch bucket and minimizing that acquisition bucket. You're really driving that repricing.
Exactly right. And so, we can see that on the next page. So, those 2 points, those 2 X's are really kind of more where you want to be. Is, for the balances you have that are less elastic, less sensitive to price, you have to price with the market. You can't fall off the cliff, right? And we hear it from credit unions all the time, like, hey, look, it's part of our value proposition that we're rewarding members. Absolutely. Nothing we're saying conflicts with that at all. You don't want to fall off the cliff. Like, customers and members have to feel like they're being taken care of. They're not being taken advantage of. You want to price with the market, not fall off the cliff. But that doesn't mean that you have to be, well above average. You don't have to be 80th percentile to get there. 80th percentile just gets you over to the right side of that area of indifference, where you're not seeing any actual behavior change for it. So what do you do with the more elastic balances? You have to have some offer that gives those more rate sensitive customers some place to put their money where they're really looking for better returns. And that's both for existing customers and members, as well as for new. Whether it's a savings or money market product that has some aspect, whether it's balanced here or relationship product, or a new money promo that offers competitive, closer to top of market rates, or a CD term that does that. But something to give that rate sensitive money a place to go. Well, you're paying fair rates on everything else. And so the key is finding those places to be. That's a whole lot of math and science, though, Dan. How do we actually help community institutions get there? And can smaller institutions have access to those same kind of data-driven insights that larger banks do?
Well, Adam, that's a great setup. It's almost like what the next slide is. Let's see. So one thing we do within our Essentials platform specifically, again, we're looking at this representative demo data, is we help you guys find that area above the area of indifference, right? Where are we really getting elastic? How are we actually moving the portfolio with rate, right? And starting to attract those balances. There's a lot to cover here because there is a lot of math, so I'm gonna keep it high level, and Adam, maybe you can help me flesh out a few things. But what you can see here in this example is there's an institution that's given us a deposit goal to reach $4 billion by the end of the calendar year. You can see the teal line, they're lagging a little bit. Maybe they've had some large CD maturity events that they weren't quite capturing those balances and seeing some attrition. And they're trying to figure out how to get back on track, right? So we've calculated for them a net growth goal to get back on track and move back towards that December balance line, and that's the $24 million. What Deposit Optimizer Essentials, the product I'm talking about today, is going to do for you is it's going to take that $24 million and say, okay, if we need to hit that number in 30 days, what is the rate in the market that's going to pull that in, right? So we're taking a look at a lot of things to do that. Heavily weighted is your institution's data. So taking a look at how are your customers in your markets performing, how are your previous rates acquiring deposits, but then also blending that and mixing it with consumer data from across the market. And we're looking at models that are talking about how do consumers in general react to these types of rates. That gets all blended together and comes out with this final rate recommendation that you can see below that says, hey, if you want to hit this rate goal of $24 million, 4.02 to 4.04 is going to clear that area of indifference, and you're going to see that kind of growth. Again, that's based off of real historical data, real modeling, and real analytics behind that.
And Dan, do we find that those strategies are the same month to month?
So actually, Essentials works on a weekly basis. So we actually refresh these numbers every week, seeing what deposits are coming in, seeing how consumers are reacting in real time. We don't necessarily recommend you change rates every week, but definitely giving an up-to-date insight in terms of, okay, what are the real rates we need to be out at so you can compare that and make some real decisions on the bank side in your pricing committees and ALCOs and everything like that.
Yeah, and next month or 2 months down the road, it might turn out that a savings offer is better, or a longer term CD is more efficient, or maybe it's still that shorter term CD, but actually it needs to be up by 15 basis points because the market's anticipating fewer Fed decreases this year. Or maybe the inflation numbers look good and you can actually drop that down to 375. There's a lot of money in those optimizations, because if you're, the difference between having to be at 375 versus 425 and making sure that you're getting the new money in the door and not just repricing your existing funds, that is an opportunity even for community institutions, typically worth well over $1 million a year in terms of getting that optimization right. So it's really, really critical and one of the best paths forward.
Yeah, and one thing I would point out to that repricing note you just made, Adam, I'm noticing that my bottom table got the headers cut off. My fault on that screenshot. But the first rate there is the offered interest rate that we're recommending. The second rate is actually taking a look at your book and at your existing members or customers' propensity to switch into those new rates. And it's actually giving you the all-in cost, or what we call the marginal cost of funds, for actually executing that strategy. So even if you go out with a 4% acquisition rate, if you're allowing existing customers to move up to that rate, what is this in total actually costing you? So we give you kind of both perspectives. It's not just, this is going to cost you a 4% interest rate. It's taking a look at your whole book and modeling that as well.
Absolutely. So price elasticity was number one. Number two key in this environment is tracking the competitive market. These rates, by the way, are different in every different market. This is kind of taking a national average. It's critical to look at this not just countrywide. Each one of your local markets are different, and we understand that. We track rates in every local market around the country. I just wanted to call out one of the interesting things that you can see here with that data, though, is it's not just important to keep track of the exact same things every week, every month, but even some of the granularity. So this is looking at CD terms, and so the black is the shortest term CDs. Then you can see the legend at the bottom, kind of going up into the 13 to 15 month space. At the start of last year, those 7 to 9 month CDs were the real sweet spot of the market, as were the 10 to 12 months. So say a 1 year CD is kind of your standard term, and you were paying 450 basis points at the beginning of last year. A little bit below that top of market rate, but your analytics say, hey, that's enough to get me new money. So you're in pretty good competitive position. You're tracking those 1 year CD rates. But what about now? If you're kind of at the same market position, maybe you're paying 310, 320 basis points on a 1 year CD, and your acquisition has gone way down. And you say, well, why is that? I look like I'm positioned pretty similar compared to those other 1 year CDs. It's because now the market has moved to 6 month CDs. And 6 month CDs are paying 360 basis points. So you're not 10 or 20 basis points below the best in the market anymore. You're 50 basis points below the best in the market. This is a really dynamic environment where things are changing. Making sure that you're on top of what all of your competitors are doing is absolutely critical to understanding where you are in the market and what kind of results you're going to get.
Yeah, and on the practical side, what that can look like is within our Essentials platform, we have a dashboard that displays a lot of quick hits around what you're looking for, trying to keep up to date with. Again, refreshed on a weekly basis. And so 3 things I'd highlight here is, to Adam's point, on the bottom first, we'll start backwards. On the bottom first, you can set up dynamic rules within the Essentials platform that will let you track a named institution and then say, hey, tell me what the highest rate CD is at that institution. Right? We're not asking you to go out and find a specific product, but rather tell us what category you're interested in. That way, every time you come into the application, we're going out, we're using our competitive intelligence and go-to-market data and saying, hey, Citibank's best CD right now is at 4.4%, and here's the term it's at, right? That way we're not, again, falling into the trap that Adam was just talking about of benchmarking against the wrong types of CD terms or different types of products, right? We can be a little more dynamic in how we're tracking that competitive intelligence and staying up to date with what actually are the best rates. Going backwards, back up the slide, we also have a deposit cost, which shows you a few key things. So first of all, your portfolio rate, what is the average rate you're paying across the portfolio? What's your acquisition rate? Again, that's new money coming in. What are we paying for that? And then along the bottom, one thing we haven't emphasized so clearly through some of these screenshots and discussions is Kiernos also benchmarks everything we do. So all the views we've seen, there's benchmarks available for all of that across the industry and across peers. So you can see right in line on the dashboard there, we've got a benchmark for the industry saying that, hey, your deposit cost is going down, the industry is going up. Congratulations, you're doing a really good job managing this year. All right.
Next couple trends really go together. So the next couple imperatives are, first, really monitoring your attrition and what's going out the door. Alongside that is making sure that you're not making short-term decisions that look good, but really setting yourself up for a much more difficult long-term. Those two go together because if you're losing relationships and losing those primary checking accounts, that takes away your ability to grow low-cost deposits into the future. It takes away your ability to cross-sell not just deposits, but all of your other products and services into an engaged and dedicated member or customer base. So what does this actually mean? We've observed over a 5-point difference in kind of the best performers versus the worst performers in losing full engaged checking relationships over the course of last year. And we've seen some FIs who have priced down far enough past that area of indifference actually lose not just the balances, but also the relationships. There really is a point where you can impact your customer or member perception of you, where they feel like they're being taken advantage of. And so that's not the goal here. The goal is to make sure that you're giving each member or each customer what they value the most. And one of the things we kind of constantly hear from frontline bankers is everybody needs rate. That's actually not true. We've done a lot of primary customer research, and when you ask people, do you want rate or do you want all these other things? If you give them the option for both, of course everybody says yes. I love both. I love the great service and all the awesome products and the best rates. If you make people choose, a lot of people say, yeah, I like rate, but it's not the most important thing to me. But there does come a point where you can actually impact that perception and your ability to grow all those other things. So, kind of keeping track of that, making sure that you're understanding everything that's going on in your portfolio so you're not losing those relationships is absolutely critical.
Yeah, and the thing I would highlight that we think is so important to do as you're looking at your data is contextualizing it, right? So as we're taking a look at what we're doing, how are we actually impacting those relationships? So this is one example just on a balance chart, right, where we can add contextualization. So there's a little dot there. You could hover over it and you could set up saying, hey, we made a rate cut in this area. We launched a marketing campaign on this date, whatever that event is you want to track. And seeing that in the time series on your dashboard really helps contextualize that and start to make those decisions a little more effective, right? So we're not just purely making decisions on what kind of things are we trying to do immediately, but how are we actually contextualizing this for the industry and for our community, and how are we thinking through what impacts these different events are having on our book.
Absolutely. Another piece of understanding that long-term value is looking at CDs. And so one of the ways we've cut this here is looking at the first time a CD comes up for maturity, how much of the balances do you keep, versus once that CD is already matured once. So that we're calling that multi-renewal CD here, right? It's coming up for its second or third or fourth maturity. How much of the balances do you keep within your institution? And across the board, we've actually cut this. One of the questions we often get is, well, sure, that seems like it's true, But I think that's because you're just looking at a lot of CD-only customers in that first-time renewal category. It's true across the board. The black on this page is kind of full relationship. We have checking, we have savings, and CDs. There's still a 6-point difference there. You're retaining 94% of the balances where a CD's already matured compared to only 88 at the first maturity. It's absolutely more stark in those first-time CD renewals, where once you can get that CD to renew once, you go up from 70% retention, so losing 30% of the balances at that first renewal, to only losing 12% of the balances at that second, third, fourth renewal. There's real long-term value in CDs. And, we're seeing a lot of institutions right now saying, hey, we're okay on volumes, we're not growing lending. We actually kind of want to run off some of those CD balances. That's something you really have to consider, the long-term impact, where if you pay a little bit more now and can keep those CDs for the long run, that may put you in better position if your goal is to start growing later this year or into next year. Kind of making sure you're considering that. The other thing that we hear often on the next page is, hey, we don't think of CDs as a relationship product. CDs are just hot money. They're basically like wholesale funding. We turn the dial up or turn the dial down. And what we see is, actually, at the average institution, only 20% of CD balances are held with CD-only customers. 80% are held with customers or members who have other products, and almost half are held by customers or members with a full suite of deposit products, so checking and savings and CDs. CDs are a really important part of relationship, and even as you see money kind of switching from checking or savings into CDs, that can be because that part of a customer's wallet or member's wallet is really more rate sensitive, and they're looking for yield on it. And there's an opportunity to keep that within your four walls, as opposed to having that go to a competitor. So really monitoring your CDs, kind of both the maturity behaviors and flows are really, really critical.
Yeah, and to that point, one thing we really emphasize within the Essentials platform is monitoring those types of flows and doing it at different levels of granularity. So from the left to the right here, we're starting very general, right? What's happening with those CDs, those term products as they mature, right? What kind of percent rolling are we seeing, switching to different products with the institution, or even just leaving the institution? Being able to track that is so critical, so you can start to plan for those upcoming maturity events. Then we can go down and do flows by category. So what is that money flowing out of CDs actually looking like, and where is it going, right? So is that money flowing into other CDs? Is it flowing into our checking accounts or savings accounts, right? Being able to track that level of granularity. And then even getting down to named flows by product. So, we've got 11-month CD promo coming up for maturity. Where are those balances actually going after maturity? So we can track down even to that named level and get a better sense of, are these moving to lower rate products, higher rate products? Are we losing them? And just trying to support, multiple levels of analytics around that CD retention and maturity events.
Great. Last point here before we kind of wrap up is, where is the market going? So we build a forecast based on all of the customer and account level deposit data that we have. And our baseline forecast is that we're likely to end up back closer to that historical growth range this year. Our kind of middle of the road is that we'll see 4 or 5 points of growth. With that said, there's a really wide uncertainty around our forecasts. What are the impacts of the tariffs and stock market volatility going to be? Does inflation continue to ebb, or does it start to come back? What does the Fed do from a rate perspective? So there's a really wide range here, and that means that you have to be monitoring a wide range of scenarios and be really nimble at your own institution. Because if you're looking for 6% growth, that might be right in line with what the market's doing, or it may be a good 4 or 5 points higher than what the market's doing. And your strategies are going to have to be really different in each of those cases. So what are the big takeaways that you know, we hope you got from this presentation? You know, first, analytics matter. And there's a lot of data out there. Bringing data to your decision making, understand how your customers or members are behaving is absolutely critical to getting the best answers. Second is, one single static strategy won't work. What worked a couple months ago isn't the best strategy for today, and that almost certainly isn't going to be the best strategy 2 or 3 months from now. You have to be tracking the market, tracking your own customer member behavior, and adapting regularly to that changing market. And then finally, think longer term. You know, make sure you're not just making the right decision for today, but that decision is going to set you up for where you want your institution to be going over the coming months and years, and that you're not you know, kind of saving a couple dollars in the short term that's going to make it a lot harder for you to grow in the longer term.
Yeah, and just a 30-second pitch here. Our Deposit Optimizer Essentials platform is designed to do almost all those things that Adam just talked about, and it's designed to do it without a large team, right? It's focused on community banks. It's focused on people who are wearing 5 different hats in your day job, right? What can you do in 15 minutes a week or less to get that data, to be able to analyze it, contextualize it, and then show up to a meeting, right? 15 minutes after you open the dashboard and go make confident recommendations saying, hey, I'm making this recommendation with the best data, the best analytics behind me. I feel confident we can make this decision and hit our goals, right? That's really what Deposit Optimizer Essentials is designed to do. And that's what we hope we could have showed a little bit today, along with providing a lot of the industry context and value there. So, yeah.
We'll wrap up here on the next page. Hopefully this presentation has proven valuable. We would love to talk to you more about what we're seeing in the deposit market, talk about how the Deposit Optimizer Essentials might help your institution. Please get in touch. This presentation will be emailed out afterwards, both the materials as well as a recording link. If you have questions about anything that you saw or heard today that we didn't get to answer on the line, you know, please reach out. We'd be happy to answer them and set up a deeper dive with you and your institution. So thank you so much for joining today and spending some time with us, and we look forward to hearing from you.
Excellent.